Hey everybody, this is Jim at SP500chart.com. It's Sunday afternoon, well actually early evening, 6:02 p.m. here on the East Coast, and we're going to use some time-honored techniques to try to understand these modern markets. It's not always easy. Well, it's never easy. Yes, I take it back. Sometimes it's fairly easy. Other times it's kind of ambiguous, and we're dealing with, I believe, sort of an ambiguous chart. So before we take a look, I just want to remind you that the website and the video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I could draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I'm not a licensed financial professional. I'm just a guy that draws lines on charts. Let's take a look. And just to remind you, this is our video in which we take a look at what happened over the entire week that ended March 1, 2013. And we're also going to take a look at what took place just on Friday. But in addition to that, I want to take a little bit broader look at what we've been seeing here lately. And the reason is this. I think we need to maybe take a look at a couple spots in the chart. One from about a little bit more than 2 years ago. Anyway, we'll do that as we get into it. But basically, the ambiguity that I alluded to in the little opening there is the fact that we've got a Rorschach test. You know what a Rorschach test is? That's an ink blot. And that's where the psychiatrist opens up the piece of paper and you look at it, and it's just a piece of paper that's had ink put on it, and it's folded over, and it's a symmetrical pattern. And one person might look at it at an ink blot and say, well, that's a demon devouring a puppy. And then another person may look at the very same ink blot and say, oh no, that's an angel protecting a kitten. So and it all depends upon your point of view, what you're predisposed to see. So as someone who tries to be almost messed up, as someone who tries to be objectionable, well, I'm sure I've done that, but that's not my intent. As someone who tries to be objective, I feel I have to look at it and say, well, here's the bullish case, here's the bearish case. Today we're going to start with the bearish case. The bearish case is we are seeing the development of a head and shoulders top. And part of this head and shoulders top includes a false breakdown that took place at the end of February. The neckline would be at roughly 1498 or so, a nearly horizontal neckline. Here would be the left shoulder, here would be the head, and then we're seeing what's a little atypical. That's the development of a higher right shoulder than the left shoulder. That's not the way you usually see these things work. But, I mean, a head and shoulders is a head and shoulders. And what we would be looking at here is this neckline at 1498, 1497, a technically significant piercing of that support line would indicate that this pattern is a head and shoulders top. Now, what makes this kind of a junky pattern to try to trade is the fact that a technically significant breaking of this neckline almost takes you down to the target, because the target height on this pattern would be the height of the neckline to the top of the head, and that would mean we'd be looking at about 1465. Well, guys, it's going to take a move down to about 1480 before we're technically significant on a breakdown. So it's really just kind of a junky pattern. It's certainly worth keeping an eye on, and I fully intend to do that. But when I say it's a junky pattern, I just mean there's not that much tradability to it if you're going to do it strictly by the book. One reason I'm still a little bit predisposed towards this being a bearish pattern is that it comes after the breakdown of this fairly long-lived channel that the S&P had been in for all of 2013. But channels break for two reasons. They either break to reverse or they break to consolidate and then continue. And right now, it's anybody's guess. That could be the case. And if that is the case, then we would be potentially looking at a pattern right here that is an inverted head and shoulders continuation forming after the breakdown of this rising channel. If that's the case, then we have a neckline that is at approximately 1525, and we have a target of roughly 1568. That may become a little bit more tradable. Not a ton more, though, because, again, a technically significant break above this line at 1525 means we got to get up to 1540 before we feel confident that this line is broken. And at that point, the market has a whole 1.8% to go before it's made the target. So you're thinking to yourself, well, gosh, of what value is even messing with the chart at this point? Well, to begin with, that's one of the reasons why I've been pointing out that since the 3/9/2009 bottom, we've been seeing a series of smaller fluctuations that really sort of begin to take the motivation out of the market to go long, or at least to go long in a big way. So, whereas back in 2010, there was a good reason to go long here. Back in 2011, even though I'll be honest, I missed that bottom. I did not see that on October 3rd, 2011. But once we formed this little inverted head and shoulders here, there was a reason to go long. We formed a little inverted pattern here, there's a reason to go long. And if you caught this bottom right here, there was a reason to go long. But now where we are, we're kind of up near the top of this range. So maybe being up near the top of this range is why we're not seeing a good reason to go long. Now I'm going to show you something that took place in 2010. We go to a 2-day chart, and I'm going to get to the weekly review. Okay, we go to a 2-day chart way back, 2010, roughly the same time of year, sorta-ish, about 3 years ago, and we saw a left shoulder, a head, and then a potential right shoulder. Then we saw a little dip right here. Here's where this neckline would have been, right there. Okay, we saw this little dip under there, and to be honest with you, if you had thought at that point, yeah, the wheels are coming off, we have a head and shoulders here, and the S&P is going to head back down under 900 or to about 900, you would have been perfectly justified in thinking that. There would have been nothing wrong with that call, except that in order for it to get down there, it would have had to have taken out the neckline to this really big inverted head and shoulders pattern that lasted 9 months in development and had not come anywhere significantly close to meeting its target. So in other words, in order for this to be a head and shoulders pattern that works, this would have to be a head and shoulders pattern that doesn't. And this was just so well formed and had been behaving so well, it was reasonable to look for a bounce once we got down to that extended neckline, because that essentially ended up being the pullback that never really quite happened. So let's go back to the 2-day chart. So at what point, and you might remember, I started doing my YouTube channel back in 2010. And at what point did it become pretty clear that instead of this being a head and shoulders top, this pattern right here, left shoulder, head, right shoulder, was a continuation pattern? At what point did that become clear? Well, for me, it became clear when this trend line drawn over this peak and this peak, when that broke out, and then it was back tested for the right shoulder. And then, of course, obviously, once it got over the neckline area that at the time I believe was right around 1130 something. So there you go. So that was when it was cemented as a working pattern. But bear in mind, during the entire formation of this pattern, the S&P had telegraphed a minimum target of 1340 to 1350 just based upon the pattern that developed and broke out in the spring of 2009. Spring, early summer. So now, let's fast forward to what we're looking at today. First off, we're looking at a much smaller pattern. And we're looking at a pattern, however, that, like then, formed what looked like a left shoulder, a head, then a short right shoulder, then it had a little fake out, breakdown, but then recovered. However, here is the analogous, if you will, or parallel line that was the first clue that this was not going to be a head and shoulders top, but an inverted head and shoulders continuation. You see that on Thursday of last week, the last day of February, we spent a little bit of that day over that line right here, but then failed to close above it. Let's move in just a little bit closer. So this was that line over the two tops that I told you about, which was the first clue that back in 2010 we were not dealing with a head and shoulders top, but rather an inverted head and shoulders continuation. This would be that line. And you can see that the market is really testing that line. We tested it here. Well, this really is the point that defined it. So you could say, well, how do you know? Well, we didn't know that was a test of this line because you needed 2 points to make the line. But this, in retrospect, this was a test that failed. We came up for a test, turned back a little bit, got over it momentarily, midday on the 28th, came down, then broke fairly decisively under that line late Thursday, early Friday. And then Friday was just a series of rallies that for the second half of the day seemed intent on just hanging on the underside of that same line. So here's the momentary break on Thursday, turned back pretty strongly, then coming back, doing little testings of this line. So, how did we do for the week if we look in terms of a weekly review? Well, I didn't feel that good or that bad about the week, to be honest with you. We knew that we were looking at a broken rising pattern here, and we saw that we were expecting a back test as a potential event to take place during the week. We got that back test. I feel pretty good about that. What was a little surprising, though, was when we started to head back down. I thought we would bounce at 1497 and maybe kick around in here and make that right shoulder. But now that we've recovered to where we are and seem intent upon testing this line, I have to mention what took place back in 2010 and how this could be a parallel to that. But in order for that to happen, we got to get over this red line, and the S&P has to take out 1525 in a manner that is unmistakable. And we just have to wait and see. So we identified a couple of 5-minute channels here, and I felt good about that. That all worked pretty well. But throughout the entire week, once we got past Tuesday's trading and we started into Wednesday, that's when this started to take on this ambiguous look. So really the thing that happened on the last week of February, to me, that I'm not really that happy about, is what looked to be a Head and Shoulders setup started to show signs of ambiguity, sort of similar to what took place in 2010. So that's kind of the if you will, that would be the weekly review. It's one of ambiguity, of seeing fairly decent down moves, then an almost absolute reversal, getting all of that lost ground back, getting back up to 1525, but then getting turned back again. So 1525 now becomes a potential inverted Head and Shoulders continuation pattern neckline. But this line down here at 1498 still stands as a potential neckline for a Head and Shoulders top. And again, if we go back to that 2-day chart and we go back to 2010, you can see the same thing, only over a much larger scale. We're talking days at what we're looking at now compared to months, what we were looking at back then. And again, that's kind of testament to the fact that everything is now getting shrunken down into much shorter time frames. So, my feeling is we may be reaching the end of this bull run based upon how things are starting to behave and how this is looking more and more like a legitimate wedge pattern that is pretty much defined all of the trading off of that March 9 low of 2009. Funny, a lot of very bearish chart technicians were calling for a wedge early on, and they were seeing all kinds of things. They were drawing these little lines that showed a wedge that would have to break down by November of 2009. None of that happened. Okay? Because, well, I mean, and I'm not saying those were horrible calls. The only problem is we always had this inverted Head and Shoulders pattern down here pointing us up to the mid-1300s the whole time. So I chose, and it's personal preference, I chose to believe this big inverted Head and Shoulders pattern through all of those bearish calls when the S&P was around 1,000. Oh, we're going to just fall off a cliff. This is it. We're going back to 400. But I said, nope. We got this big pattern down here. It's pointing us to 1350. But now, I think there is a very legitimate concern that we have a wedge. And the wedge has not lasted just a few months. The wedge has lasted about 4 years. So I'm watching this really closely. It looks like we're getting very close to a potential major top. We do not have the pattern. We do not have anything formed yet that says that. But just where we are in the chart, the shape of all of the trading that's taken place for 4 years, the fact that it's looking like it's getting squeezed down more and more to where at some point the natural outcome of this should be that selling pressure will take over. It will form a top. So guys, there's your video for the week ending March 1, 2009. Let's get 2009. I was so used to saying March 9th, 2009, March 1, 2013. And again, watching 1497, 1498 as important support, and 15 and a quarter as pretty important resistance. So there you have it. Thanks for watching. And if you're not a subscriber, think about it. It's cheap. You might learn something. Come on over to sp500chart.com. See what it takes to get these technical analysis videos every day after the close without delay. Thanks for considering it. Thank you for your subscription if you're a subscriber. I do appreciate it. And my goal is just to be honest and share with you what I think I've learned over the years. And hopefully you can start to incorporate these same things into your own analysis of the markets. That is the ultimate goal. I don't want to tell you what to do, but I just want to show you what has a tendency to take place in the chart. So thanks again for watching. Take care.